Why did that not? She didn't tell everybody we're on. Yeah, should be.
All right. Thank you all for joining me today. My name is Phil Roberts, and I'm an annuity specialist here at Great Plains. Today I'm going to talk to you about some challenges that today's retirees face and how income riders can help them hurdle these challenges. Specifically, income riders with stacking income credits and increasing income. It is still a fairly new concept out in the annuity industry, and many agents have misconceptions on how they work. So hopefully after today you have a better understanding of them. And I'll briefly go over a couple of the products that have it and have this tried wrapped up within 15 minutes here. I know your time is important, so I don't want to keep you too much over the lunch hour here. But anyways, we'll get into this. So baby boomers, they are retiring at retire much differently than their parents. Their parents had pensions, and today only about 18% of the workforce has pensions. That puts a lot of responsibility on the retiree or soon-to-be retiree on how they are going to manage their retirement income. Not to mention they are living longer and inflation will only go up. We have also been on quite a bull run, and this past week we've seen extreme volatility in the markets. It's brought up a lot of conversations this week with agents about another challenge sequence of return risk. If the client's retiring today and the market takes a hit while they're taking those distributions, they have a difficult time making that income last. And all these moving parts puts a strain on your client's retirement income. So it may be time to think about protecting some of their assets. Now, people put insurance on their homes, their cars, their lives, but rarely do they think about insuring their income. No one wants to outlive their money, so taking a closer look at some of these increasing income riders, that might just help some of your clients through their retirement. Now, you all have probably seen longevity tables out there. So we'll just briefly go through this one because I'm going to take an example from this and keep going through this presentation. So right here, this is telling you that a male age 60, they have a 50% chance of living to age 88, a 25% chance of living to age 94, and a 5% chance of living to age 100. Now, everyone knows that females, they live a little bit longer than the males, so they have a 50% chance of living to age 90, female age 60 that is, a 25% chance of making it to age 96, a 5% chance to make it to 102. But now if you're sitting down with a couple, it's important to take both of those lives into consideration. So this bottom line here is telling you that at least one of them has a 50% chance to make it to age 94, and 25% chance to make it to age 98, and a 5% chance to make it to age 103. Inflation risk. We're going to look back 27 years here. A lot of times, today's retirees, if they're retiring at age 60 or 65, there's a good chance that we looked at those longevity tables, so there's a good chance they could be living another 27 years. So if we look back, 1990, gallon of milk is $2.78. Today it's $3.51. Gas, a gallon, $1.34. Today it's $2.49, but as you know, that could be a lot more volatile than that, so that changes quite a bit. Honda Accord in 1990 was $12,000. 2017, $26,000. The median home was $101,000 in 1990. 2017 was $189,000. And Super Bowl tickets in 1990, that was when Montana 49ers were taking on Elway and the Broncos. They were $125 in average price. Last year, the cheap end was $2,500. This year, I haven't updated it, but just last week, I saw where the cheapest one was just over $3,000. So pretty ridiculous there. But as you look here, if your client is getting retirement income from a SPIA, a level, or a pension, any type of level payment, an income rider that maybe gives level payments, you can see that their purchasing power just erodes over time just because of what inflation's doing to them. Now here are the two products that I'm going to go over today. We'll walk through a couple illustrations. The first one is the Alliance 222, and this one, it has a 15% premium bonus on the income base. The interest bonus of 50% of the crediting interest goes to the income base each year. Now, I'll slow that down a little bit. What I mean there is that, let's say your crediting strategy that you choose for your client earns them 4%. Well, 4% is going to go to the account value or the accumulation value, and an extra 50% is going to go to the income base. So that income base is going to get 6%. There is a death benefit, and it's the account value or the income base over 5 years I do see some agents out there who put this on clients solely for the death benefit. They just let that death benefit ride, or the income base just grow if they can't get through underwriting on a life insurance contract. There's no fees or rider charges on this product. How do they get away with that? Well, let's look at that bottom line there. They must wait 10 years to turn on the income. So they know that they're going to have, the carrier knows that they're going to have the money for a while, so they can waive those fees and rider charges. The second one here, this is a proprietary product that we have here. There's only a few selected IMOs that are able to sell it. We're one of them, fortunately. So it has a 10% premium bonus on the income base. The income base also has a 4% plus dollar amount of crediting interest to the income base each year. So each year you're going to get 4% compounding interest, and whatever dollar amount you make from the crediting interest strategies, that will go towards the income base as well. And that income base can roll up for a period of 20 years. There's a 90 basis points rider charge. And on this one, income withdrawals may begin after the first year. This one has two low volatility indices on it. And last year, one of them in 2017 had a return of close to 18%. Really something you just don't see in FIAs a whole lot. And I actually just saw a statement, anniversary date at the end of January, where someone got credited 20%. Pretty unreal. And that's not, it wouldn't be something you expect to see every year, but something you don't typically see on an FIA. Now here we have an illustration for the Guggenheim Trivista. Here we have a client, male, age 65. He's putting $200,000 in this at the age of 65. And then he's going to turn on that income at age 69. And I have that highlighted there in that red box, because as you see there, he starts off with $12,400, goes up to $12,593, and it just keeps rising until that 20th year. Well, that's because his performance is outperforming that payout percentage. So his crediting interest rate and that 4% is still happening as he's got the income turned on. So that's how you're seeing those increases in payments. And why does it stop at 20 years? Again, because it only lasts, that roll-up only goes 20 years. And I say only, which is a long time, because most of them you might only see 10 or 14 years. So 20 years, it's a pretty good product out there, especially if they're taking income after 10 years, maybe income down the road. The second one here is the All-Else 222 illustration. We have a male, age 60 in this one, starting with a premium of $200,000. So if you look at that red box there on top, there's a lot of numbers up there, but I'm going to show that this crediting strategy we have is a cap of 3.5%. So the account value went to $207,000. Look to the far right over there where it says protected income value. That's the income base. That's the one that got the 20% premium bonus. It got that 3.5% plus another 50%. So that PIV credit comes up to 5.25. That's the protected income value credit. So that's what gets credited to the income base. So that's how you see that protected income value or income base at $242,000. Now let's look down here where they start taking income. After 10 years, they turn on the income rider. If you look at the protected income value at year 11, it's at $357,953. That's what they're going to base that payout percentage on. So that's how they get that $18,233. Well, if you look at that year 12 and they take or getting income, look there, they get another, or they get a pay increase. It's not a level payment. So whatever the protected income value, whatever that value is, that's how much that paycheck will go up the following year. So that $18,223 went up by 5.25%, and that gave you $19,180. This next slide, I'm going to highlight down here at the bottom, because you see the account value goes to zero, but if you look over to the right, that income value is still rising. So even when this account value hits zero, your customer is still getting pay increases. Pretty strong tool, especially when they're wanting to fight inflation and if they're living long enough to see that. So here I wanted to just compare a product that gives a level income, a competitive product out there that gives a level income payment. So on the left there we have the All-Else 222 with a premium of $200,000, age 60, income at 70. And the level income products get same premium, age 60, and income at 70 as well. It has a 10% premium bonus on the account value, or on the income value, and 10% simple roll-up. So that first year payment, All-Else 222, is paying out $18,323. The competitive product is $19,530. Now that is paying out a little bit more, but it's going to be a level payment. So if you look at the payment at age 90, if we're assuming 2.75 each year, at age 90 they're getting $43,478, while the other one's still getting $19,530. And if you look at that life expectancy at total income at 94, the Allianz 222 pays almost $200,000 more over the level income product. Now it's important to point out that the 222 and the Guggenheim Trivista, they are not guaranteed products. They are built for potential. So if you are wanting something that client just needs a guarantee, we do have an income software in-house where we can go out there and shop those highest guarantees for you. And I have a lot of reps that will do split cases. They'll do 50% in a guaranteed income base, and then one with the potential for the increase in income as well. I'm going to reach out to all you today after this presentation, or just send you an email with a one-page case design form. It's just one page. I just would need specific information from you. That way I can do some case design for you, whether you're looking for income, wealth transfer, long-term care riders, death benefit, accumulation, whatever it is. We have 30 carriers in-house. I'm sure we can find something to help your guys' needs with your clients. I want to thank you all again for joining me today. Like I said, I wanted to keep it short today because I know you guys are pretty busy. But thanks again. I hope you have a great day.